Our next topic is investment recommendations for fixed income, which I will discuss with Eric Domergue of Generali Investments. What are your broad views, Eric, about government bond and credit market prospects?
In fact, we became neutral on the rates on Europe and US. And in Europe, we were overweight peripherals, but we now stay neutral. There are some the Brexit referendum and the Spanish elections, and we think that there should be some volatility until the end of June. So we stay cautious, and we think that peripherals offer value in a longer term view, and we will, I think, continue to be overweight after those political events, but right now we are cautious. But we think that due to the ECB asset purchase program on sovereign debt, also the search for yield for investors, and the fact that all these countries have issued more than forecasted. So the rest of the year should be a better environment for this country. On the credit part, we are positive on IG, both euro and dollar, slightly positive on European high yield, and neutral on US high yield. We think that the ECB program is improving the horizon for especially the IG, as the program covers only IG issuers, only non-financial issuers, but they also can buy crossover names. So there will be a kind of contagion, positive contagion to European high yield. And as the rating drift in Europe is positive, this means that the number of issuers being upgraded is far more important than the number of issuers that are being downgraded. We think that it's good for the European credit in general.
So do you feel that despite the risks, there is some improving sentiment, which means that investors can afford maybe to take on slightly more risk?
Yes, I think so. I think that due to the low yield environment, almost half of the European sovereign market is trading at negative yield. Investors want to search for yield. And in Europe, the trend in credit is improving. We have seen it with the statistical of default in Europe. Moody's expect that the default rate in Europe will stay low at around 2.5%, while in the US it has already come up to a little bit more than 4% and will surely come to 6% in the next year. So in Europe we have some improvement. In fact, the companies have not leverage like in the US. In the US, they have issued debt to pay dividend and to buy back stocks. This is not the fact in Europe, and we don't expect it. So clearly, the quality is in Europe, actually.